Thank you for coming today. Happy to be back with you, and I know this little slide up here. Don't we wish?
Yes.
Yes, we wish our Form 2010 was that easy. Just put down your income, subtract your expenses, and always have it be zero. That's the point. Anyway, I want to cover a couple things today. Last year, I didn't leave enough time for question and answer, and I have class at 1 o'clock, so I'm going to try to leave at least 10 or 15 minutes for question and answers today, so that if you have some questions, we can get that answered. But let me tell you some of the things, though, that I really want to hit today, mostly today that I think I rushed over a little bit last year, and I think they're very important. First of all, I'm going to cover the first one, have my taxes increased. I want to talk about that very first because that's a question that comes up quite often, that I have a lot of people from the university send me an email and ask me that question about different things that they've heard. So I'll cover that right off the top. I'm going to skip filing status. I'm going to talk maybe briefly about dependent qualifications. I'm going to skip sources of income, and I want to go down to itemized deductions. I want to talk specifically about how to lower your income tax and about some education credits, because I think that's very applicable for this audience that we have. So that's where I want to go today, and then if I have time, I'll hit some of these other topics. But for today, those are the things that I'm going to talk about. So first of all, and I showed these, I haven't been very creative this year, but there's your tax return. It kind of feels like that, I'm sure, again, like a big maze. But here is the question that I get all the time. We've heard about all of the different problems that our economy is in, that our country's in, and what's happening with our economy. So the question I get all the time is, my income taxes are going to increase. I hear that there's a 4% increase. I hear that there's a 1% increase. You know, Mary, how is that going to impact me? And so I wanted to hit that really quick because I know you all felt it at the beginning of the year. In January, when you got your paycheck, it was less than it was in December. And that is because, so my answer to my question, no and yes, is correct. And here's the reason why. Because for 2 years, we had a nice little tax break. We had a 2% cut in Social Security tax that we pay in. So out of your paycheck every month, 6.2% comes out for Social Security tax, and 1.45% comes out for Medicare. You pay for that because you're paying into Social Security for benefits when you retire, and you're paying into Medicare, so you can get Medicare insurance when you retire. Well, for 2 years, Congress passed, it was supposed to help employers be able to not have to pay so much in taxes and employees to help with the status of our economy. So they gave us a 2% decrease in Social Security tax back in 2011. And that was supposed to expire at the end of 2011, and we were supposed to go back to 6.2%. So for 1 year, we were supposed to have a 4.2% nice little break. But then what happened is in 2012, they extended that 1 more year. So we had a 2-year break where we were only paying in 4.2% Social Security. So what happened this year is I got a lot of phone calls saying, Mary, I'm not living on as much. Boy, those taxes have really gone up. And then you put that together with everything else that you hear about how taxes are going to increase and our country's going to go right down the tubes. So, you know, you put that all together, and those were the types of questions that I had. Well, in reality, and by the way, I apologize, if I call you class, it's just normal. So if I call you class, it's not that you're, my students. I guess you are for a few minutes. But anyway, that 2% expired December 31st of 2012. And so now you had to pay into Social Security more. So that answers that first question, which, by the way, if Social Security, once you earn $110,100, you don't have to pay Social Security tax anyway. So that's what you're going to aspire to, okay? To be able to make $110,100 so you don't have to pay Social Security tax of 6.2% anymore. But anyway, so for now, the answer is, have my taxes increased? The answer is yes. They increased 2% into Social Security. But in reality, 6.2% had been your Social Security tax for years and years and years. So that's why it's a no, because you'd been paying that amount of tax for over 20 some odd years. Okay? So your taxes have not, in reality, increased. It's just that we had a little nice tax break for 2011, 2012. Okay, and then another thing that I hear from people is this last little bullet point down here. You hear about that the tax rates are increasing. Yes, they are. They are increasing, but they're only increasing for those people that earn over $450,000 of taxable income, which I know everyone in this room wants to be in that problem as well. Wants to have that problem, but in reality, well, actually, I'm not going to assume anything. So anyway, taxes have increased, but only for high income tax earners. So that should resolve also that issue, okay? That your tax rates are not increasing and that your Social Security is just going back to what it always has been, okay? All right. There is another tax increase, though, that might impact some of you, especially what I'm seeing is for some of my clients who have inherited property or have acquired rental properties over the years. This one right here might hurt you, this capital gains tax increase. What happened in 2013 is that if you happen to have a rental property, I think this is where it's really going to hurt people. You have a rental property that you acquired for, let's say that you bought it for $100,000 back in the 80s or maybe mid-80s, and now over the next 4 or 5 years, you sell that rental property for $400,000. Well, if you have over $250,000 of capital gains, you bought it for $100,000, you sold it for $400,000, you've got a $300,000 capital gain. Anything over $250,000, you're going to pay an additional 3.8% tax. That's another thing that's kind of been floating out there. There's a capital gains tax. If I sell my house, am I going to have to pay capital gains tax? And the answer is no. You don't have to pay a tax on your home sale because that's not investment property. That's a personal residence. Okay? So there's still going to be an exclusion for your personal home. I'm talking about investments that you have. Again, you all want to be in this problem. You would like to have investments that you're selling and you're going to have over $250,000 of income added into your income. And if you did, you're going to pay an additional 3.8% tax this year. Something that hasn't been around in the lifetime that I've ever done taxes. They've never had a capital gains tax like this. So that is new. But again, it's kind of far-fetched out there. Unless you've acquired some rental properties or some investments maybe from inheritance or you've acquired them throughout your lifetime, you might have that situation. That's one that could be there. But again, you have to have $250,000 of investment income is the key word. Okay, I want to talk a few minutes. I'm going to go past some of these because I want to go into who you can claim on your taxes just briefly. Because I get this question a lot too. I have a lot of emails from SUU faculty and staff that call and ask or email me and say, can I claim my child after they graduate from high school? And the answer is yes. You can claim your child until they become, if they're a full-time student and under the age of 24. And then once they go over that, then you have to determine if they have over $3,900, of income, and they live with you, then you're probably going to lose them as a dependent if they're not a full-time student, okay? So you have to test your children's income. If your children have earned over $3,900, then you cannot claim them anymore. They're independent, all right? Okay, unless they're under the age of 24 and a full-time student. So that should maybe clear up that, because that always comes up. Can I claim my child? Yes, as long as they're a full-time student and earn under $3,900. Okay, I want to go into talking about things that can reduce your taxable income. So how can you pull your taxes down? Well, there's two deductions that you can take, and then there's credits that reduce your income. So we in tax lingo, we put them into two categories, deductions versus credits. That both are ways to reduce your tax liability, what you owe to the government. And this one up here, are some things that can reduce your income. So this education expenses, if you teach school under high school, you can take this educator's deduction of $250. If you, on your health savings accounts, now this is something that Travis asked me to go over because we switched over to a high deductible plan. And many of you are getting a 1099 SA form in the mail. Did you get one of those from Optimum Health this year? Right? Okay, and so the question is, do I have to include that? And what if you use Tax Act or if you use one of those programs, it comes in and it pops into your income on your W-2. There's a place on there that says what contributions the university has made for you tax-free. And it's on your W-2. So when you're entering it in Tax Act, you're entering in all of your W-2, and in box 12 it says what you've paid into an HSA account. Then you have this form that comes in from Optimum Health that says this is the amount of deductions that came out of that HSA account. So here's the key point for you on this. Are they taxable? Because I think automatically it comes in and looks like it's taxable once you put in the form from Optimum Health that says, some of you may be doing that, where it says that you took out of your HSA account $2,000 for medical. And it's going to automatically include it in your income. But the point is this, you do not have to include in your income any of your HSA contributions as long as you've used the distributions for qualified medical expenses. Okay, so if you took out of your HSA account $2,000 for qualified medical expenses and you used it for qualified medical, you don't have to include that amount in your income that's on the 1099 SA. And you're going to fill out a form, and I think I put it down here. You're going to fill out a form, an 8889 is what you have to generate. It's with health savings accounts. And you have to put on there what type of health savings, if you're just covering yourself or if you're covering your whole family. And then you have to put in there that you have made qualified contributions and you've made qualified distributions for medical expenses out of that HSA. And if they match, you're in good shape. You don't have any taxable income that's going to impact you. Does that make sense? Yes? Okay, so you still have to report this form because on this form, down lower it says what were your contributions, and then you have to put what were your qualified distributions. And again, if you're not going to have anything taxable to you if you've done that. So it's a great HSA account. I think it's a great plan. It's paid off for me this year. I hope it has for you as well. Okay, so you have to file an 8889. Don't include it in your income as long as you've used it for qualified medical expenses. And you have to check the box to do that. On the 8889, you have to make sure that you put it for qualified medical expenses. Otherwise, automatically it includes whatever your distributions were on the 1099 SA form in your income. Okay, I want to go back to other items that decrease your taxable income. By the way, just so you know, this year, if you have a family plan, a family HSA, you can contribute $6,450. I've decided to maximize my HSA as much as I can because I like the fact that if I need it, it's tax-free coming out of my check, and I can use it for qualified medical expenses, which I never can take on an itemized return. So I maximize it, and I like the fact that if I don't use it, I get to keep it, and it'll just continue to grow until I retire, and then I can convert it over to an IRA, and it's in my retirement account. So, like I say, I think it's a great plan for those of you that don't maybe use all your medical. It can serve as a retirement or a savings account, savings plan for you because you don't lose it like you used to. I'm sorry, Lee, I keep touching my microphone. I'll try not to. But anyways, you can contribute $6,450 this year if you're a family and $3,250 earning tax-free dollars. And if you haven't looked at the tax savings that it's done, go on to your Tango Health account and you can see how much it's saving you in taxes to contribute to that HSA account. Okay, other items to decrease your taxable income. If you move, you have to move over 50 miles. So if you're just moving from one house in Cedar to another house in Cedar City or even to Parowan, you're not going to be able to qualify for a moving expense deduction. So don't take that. If you have alimony to a spouse, an ex-spouse, you can take that as a deduction. You also can take as a deduction contributions to your IRA, and I upped that limit. If you look there, you can contribute $5,500 to an IRA, and $6,500 if you're over 50. Now that's also a deduction for you on your tax return. One other item that's pretty slick, if you have, because we're in a room with, at a university, you might have some student loan interest. Don't forget you can deduct your student loan interest up to $2,500 also. That reduces your income. And one thing that also people ask is about Roth IRAs. One thing you need to remember with a Roth IRA is that you're paying for that Roth IRA out of money that's already being taxed. It's coming out of your income after you pay Social Security and Medicare tax on it. So it's an after-tax deduction. And so it's going to grow tax-free throughout your lifetime. And then when you withdraw it, it's also a tax-free distribution. But here's the thing that's interesting. And advisors always say, put it into a Roth, put it into a Roth. But I find that a little, as an accountant, I look at it a little differently, because some of my clients in today are paying taxes in 25, 28, 30% tax rate. And so if they put it into a Roth, sure, they're not paying the 30, they're paying the 30% on it today, and maybe their retirement income is only going to be taxed at 15 or 21% interest. I have a client that lives on his savings account. Well, his savings account he already paid taxes on. So his tax rate today is only 15% versus when he was working, he was in the 31% tax bracket. So that's something that you need to weigh. Of course, we don't know where taxes are going to go, and any investment advisor is going to tell you that. Taxes are increasing. You're going to pay a high tax rate when you retire. Tax rates have been the same for about the last 20 years. They haven't increased much. So Roth IRAs, those are contributions, of course, that are not deductible, not taxed. You pay them after you pay Social Security and Medicare tax. Okay. Not a deduction from your income tax. All right, I'm going to go ahead and come back to that later. Here are the tax brackets, just so you know. Most people in the United States fall right here in this 15% tax bracket, where most individuals are 15%. This is taxable income, by the way, not gross. So if you're making $40,000 at the university, by the time you take off your standard deduction and your exemptions with that, you're going to probably be right here in this range. And so you would say you were in the 15% tax bracket. And then you can see how it increases. Once you're married and your taxable income goes over $70,701, you'd bump up to this 25, 28, 33, 35, and now we have a nice little new tax bracket for those that earn over $450 at 38.7, or let's see, 36%, excuse me, 36%. Okay, so that's kind of your tax brackets. Maybe you'll want to kind of look at that because there's a big jump between 15 and 25. So if you are earning, once you go over 70, you just took a 10% tax increase that you're going to have to pay. So a lot of times I try to keep if I can do it, I try to keep their income less than that, save them that 10% jump between the 15 and the 25. Okay, let's go ahead and I want to go into other items to decrease your income. Medical and dental expenses. This is the summary, and I'm going to go ahead and I have individual slides on each one, so I'm going to go ahead and go forward. You can deduct medical and dental expenses. And people always ask me, Mary, should I bring you all my receipts for my medical and dentals? And the answer is maybe, because you can only deduct your medical and dental expenses if they're over 7.5% of your adjusted gross income, which means this. If you make $50,000 at the university, and we take off $20,000 in you're married and you have some children, so now your adjusted gross income is $30,000. You take that and multiply that by 7.5%. So you've got, in order for you to deduct any medical expenses at all, you'd have to have over about $8,000 out of pocket medical. Okay? So you have to add up all your prescriptions, all your co-pays, all your dental premiums, medical premiums, and if they're not over $8,000, you can't deduct a penny. That's why I love the HSA, because I get to take it out tax-free I don't have to pay Social Security or Medicare tax on it. I never get to itemize my medical anyway because I never have enough. But now I can take a nice little break on it when I'm contributing to my HSA account, and I basically get to deduct it up front. Does that make sense? Because most people, you don't want to have that expense. You don't want to be able to itemize medical and dental. That means you've had a rough year. And so the way to take advantage of that is to be able to set up an HSA and take the deduction through tax-free contributions to that HSA account. Okay? So there's a limit on it. Now, you can't see all this, but people say, can I deduct my gym membership? I got to go to the gym, health club dues. I got to go to the gym because I'd have to go to the doctor more often if I didn't go to the gym. You can't take that. That's not going to be allowed as a deduction as medical and dental expenses. But, and another question that comes up, can I take Tylenol and ibuprofen as a medical or dental expense? And the answer to that is no, unless your doctor has prescribed it as a way of maintaining or decreasing a medical condition you have that you've been diagnosed with. You can't take that as a deduction for medical and dental expenses, and you can't take it on your HSA either. Okay, so there are some things that you can't. Bandages, that's if you needed to do it. You can take some bandages. There's a nice list. By the way, this little, if you ever are wondering about medical and dental, if you'll go in and Google, it's called a Pub 17, medical and dental expenses. If you Google that, it's going to tell you what you can take as a deduction. Okay, so the next item down. So what lowers your taxable income? So I'm talking about things, I better go back here, talking about itemized deductions. So I always get questions about, can I itemize my deductions? It's an either or question. You can either itemize or take a standard deduction. See, right now, the standard deduction, if you're single, is $5,950 if you're single. If you're married, your standard deduction is $11,900. That's given to you. You're going to automatically get that. So you can either take that or itemize your deductions. On the itemized deduction schedule, you take medical and dental expenses. That's where the 7.5% comes in. The next category down are taxes. Taxes that you can deduct. Well, the taxes that you can deduct are, you can either deduct state taxes that you paid in. So on your paychecks, you know how you pay in state withholding? To the state of Utah, it says state withholding. That's deductible to you, what you pay into the state of Utah for state withholding. That's a deduction. You can take that, or you can take sales tax for another year, which is on sales tax that you pay for all of your products, things that you buy. So even your vehicles. If you buy vehicles or boats and you pay sales tax, you can take that as a deduction. So it's an either or deduction. State tax that comes out of your paycheck, you can deduct, or sales tax that you pay. And the question is, do I have to keep every receipt that I have throughout the year? And the answer is no, because the government gives you an allotment based upon your income and estimated sales tax, and then you can add to that like vehicles or boats or four-wheelers or things like that you might buy. Make sense? Either or, state or sales. Okay, so now we've covered two items, itemized deductions. So you decide, I'm not going to take the standard deduction, I'm going to itemize. Take medical and dental, sales, and state tax. Sales or state tax. So we've covered two items. Now, the next thing that you can deduct are real estate taxes. If you own a home or you even own you own property or land, you can deduct the real estate taxes that you pay on any real estate, on your principal residence plus other land or buildings that you might own. You can also deduct mortgage interest. So if you own a home, you can deduct the mortgage interest on your home that you live in plus a second home. So if you have another home, you can also deduct that mortgage interest. You can also deduct mortgage insurance premiums that you have paid after 2006, and that seems to come in and play quite a big amount when people are refinancing their homes. And you're only going to have mortgage insurance premiums, by the way, if you have less than 25% equity in your home. So not everybody's going to have mortgage insurance premiums. But if you do, you can deduct those. Does that make sense? Okay. So we've covered medical, dental, real estate tax, sales estate tax, mortgage interest. Now we're down to the next itemized deduction that you'll want to keep track of. Those are charitable contributions. You can take anything that you have coming out of your paycheck for SUU. My husband and I my husband gives $500 to nursing, and I give some to the School of Business every year. Not that much. I shouldn't say that. Dean Templin's not here. I only give about 48 or something, not much. But yeah, I told him though, you got to convert nursing. They're fine. You need to give to the School of Business. I'm just anyway. You can deduct those contributions to SUU. SUU is a university and institution that qualifies for charitable contributions, so you can deduct those. You can deduct them to your church. You can also deduct non-cash items that you give away. People forget that all the time. If you give items to Desert Industries, or you give to Care and Share, or you give to the Children's Crisis Center, you can deduct the value of the material that you put in there. I have people that sew quilts up and they give them to the Children's Crisis Center. Well, you can deduct the cost of all the material that you put into those quilts as a charitable donation. If you have a calling to be in the Boy Scouts, and you have to go to Boy Scout camp or Girls camp, and you have to drive, you can take miles at 14 cents a mile as a deduction. I always keep track of those. I can even take the miles deduction to go from my house to DI to drop off items and back as a deduction. So you can take charitable miles. You can also take charitable non-cash items, clothing and furniture that you deduct to DI. Just make sure you get a receipt from Deseret Industries or from the Catholic Thrift Store, wherever you decide to donate. Make sure you get a receipt and you deduct off of that. I always deduct what I think DI would sell it for. Okay, so that's another great place for you to keep track of charitable contributions. And I have a little item here. I have another couple of clients that, one that goes down to Mexico. I have another one that goes to El Salvador, and they go and donate their time and go and build homes or build schools or something like that. And I know the university does that. They take the kids down. They take the kids down and go and do some charitable work. I know that Rural Health Scholars does that. Well, you can take your miles to drive down there, or you can take your flight to drive down there and do charitable work, and you can take normal lodging and expenses while you're there. So it's a pretty nice deduction for you to be able to take for charitable giving, charitable miles and lodging expenses, out-of-pocket expenses. So it's a nice, see, I have a little bullet points there, hotel, lodging, airfare, while you're giving of yourself with these charitable entities. So keep that in mind if you do that, because that's a nice way of being able to take that as a deduction. You can only deduct up to 50% of your income as a charitable donation, and then, so if you're making 50, you can give 25, and then you can, if you give more than that, then you have to carry it over to another year. You can carry it over and take it as a deduction for 5 years. Okay. One thing that I did want to cover is something that might be applicable to you. If you have some out-of-pocket job expenses, now SUU is a pretty darn good place to work because they really cover most of your expenses whenever they have you go somewhere for work. And I think that's really a really great benefit that they give us, because a lot of places don't do that. So, but if you happened to travel somewhere and you had some out-of-pocket expenses that you didn't ask the university to reimburse you for, you can take that as an itemized deduction. So all the things we've been talking about go on one form. When people say they itemize, these are what we're talking about. And at the very bottom is where we take unreimbursed employee expenses. That's where we take miles in our car. I have a gal that I work with in my department, and she takes students all over the place doing different field trips and things like that. And sometimes she gets reimbursed and sometimes she doesn't. And so she'll give me a list of all of her miles that she hasn't turned in for the year, and I take them as a deduction on her. And she'll buy different supplies, things that she thinks would be helpful for her students. And I just ask her for all those, and we take that as a deduction. But again, remember the medical and dental you had to have over 7.5% of your adjusted gross? Employee expenses have to be over 2% of your adjusted gross. So you have kind of a limit in there that you have to get over. Okay. Credits. These are the good ones. This is what we want to tap into. Credits are dollar for dollar off of your taxable, taxable bill. So at the end of the year, it says you have a tax liability of $1,000. Well, the way that you get that $1,000 down is right here through a credit. But unfortunately, there's only a few credits that really 98% of the population can even tap into. The other two are so rarely used. The other 2% are the credits that are really out there. But if you have child care and your children are being cared for while you're at work, and remember, this is where if you're a married couple and the wife has to work. If the husband works and the wife stays at home and we put the kids in preschool, we can't take child care expenses. But if the husband and wife both work, then you can take child care expenses as a deduction. It's 20% of whatever you pay, up to a certain limit. So if you paid $4,000 in child care or $5,000 in child care during the year, which lots of people meet, you can take a 20% deduction for that up to $400. You can also take retirement savings credit. If you earned less than, and that 57.5, that's actually, I think I forgot to change that for 2013. It's up in 60,000. So if you earn less than 60,000, you put money in a 401k, like you have a 403b at work, at SUU, you can get a nice little retirement credit, which is a 10% credit off of your taxes. So remember, if you had a tax liability of $1,000, you're reducing that now with a retirement credit. So if you put $1,000 into your 403b, you can take a $100 credit. So now your $1,000 tax liability just went down to $900. Okay? A child tax credit, you can take $1,000 for every child that you have under the age of 17. That doesn't mean you can't claim them as a dependent, though. Make sure we're clear. You can still claim them as a dependent, remember, if they're a full-time student under the age of 24. But you can only take a $1,000 child tax credit until they're 17. By the way, next year, that's going down to $500. And 2 years from now, that's going to be gone. So people that are getting nice refunds, that's going to be gone. Okay, so enjoy it while it's there. Next year, if you have 4 kids and you're getting $4,000 child tax credit, next year it's going to be $2,000. You watch that. Every person I see that has kids this year, I am honing them in on that. Okay, this year you're getting $3,000 back. Next year it's going to be $2,000 because you only get $500 per child. That's why I put it in nice big red letters. Okay, residential energy credit. You can get a nice credit if you put in energy efficient windows, doors, insulation. Keep track of that. Furnaces, air conditioning units. And the adoption credit. And these are really about the only ones that you can tap into. So if there's anything else out there that people talk about, there is one more that I don't put on here, and that's education credit is also included in there, which is where I want to go right now. I want to go to the education credit because I'm running out of time. It's time for Q&A. The time? 22. Ooh, 22. Okay, I better quickly get there. Education credits, really fast. If you are taking a class or you have a child that's taking a class or you're taking a class at the university, we get a nice little perk for that as well. But if you have a child that you're having to pay tuition for, or you know somebody you're having to pay tuition for, the best credit up there is the American Opportunity Credit. And it's a $2,500 credit that's eligible for students that are within their first 4 years of education. So first 4 years of education, you can take an American Opportunity Credit. Remember when we talked about the tax bill of $1,000 that you had owing? Well, if you are in a master's program and you're paying $6,000 for tuition, you can qualify for the Lifetime Learning Credit and get a $2,000 tax credit and basically take that $1,000 credit to zero. Okay, but the American Opportunity Credit is $2,500 credit that's eligible, that you're eligible for, and $1,000 of that can be refundable. It's a refundable credit, so they'll actually give you back $1,000 in your pocket even if you didn't have any tax liability. So it's an awesome credit. So don't forget to take your education. By the way, though, real quick, this right here, if you qualify for this credit, so remember it's only 4 years, You can take tuition fees, books and supplies, required books and supplies. It's an awesome credit. Down here, you can only take books and fees. Okay? And down here, you can only take books and fees. So you got 4 credits. If you've been in school more than 4 years, you're toast if you've taken that credit. Okay, I've got to stop because I need to give you some time. Those are some ways for you to decrease your tax liability. And really, those are the things that when somebody comes out with some crazy other way of decreasing your tax liability, beware, because those are the ones that 98% of the population can take advantage of. Okay? So I think I've covered those. Okay, questions? Yeah?
The high efficiency for the energy.
Sure. Uh-huh.
Can you take that and build a house?
No. Can't be on new construction. It has to be a replacement. So good. Thank you for bringing that up. Can you take it on a new house? No, but if you have an older home and you're replacing it with these items, that's where the credit applies. And it can't be, you also can't take the credit if you have it on a rental property. Okay. What else?
So I have a child that graduated in May out here, and so she was a student for that portion of the time, but now she has a full-time job. So is it and or on the $3,900 and she was under 24 for full-time student?
If she was a full-time student for half the year, then you can claim her. So she went spring and then she graduated in May. That's her last year claiming her.
She's now earned over $3,900.
Yeah. Yeah. Yep. And then next year you're out of there because she's graduated. And even though she's under 24, she's earned over $3,900, and now she's on her own. Yep. I have another client that has a student that's getting his a son that's getting his PhD, and the dad helps him out all the time in school to help him cover his living expenses. And he's about 27, and he doesn't earn $3,900, but of course he's over 24, right? So can he claim it? He doesn't earn $3,900, but he's over 24, and he's my client's son. Can he claim it? Yes, he can, because he earned less than $3,900. See, he's a full-time student on a grant that covers his tuition. It's non-taxable, but his father's paying his living expenses. His father's providing over half of his support, and he earned less than $3,900, and he's 27, so he can claim him. So he does. Should I test you again? Don't ask me questions. I'm going to give you a pop quiz. Okay, looks like you need a pop quiz. How much can you take if you are, for your medical and dental expenses? What's the limit that you have to get over to be able to deduct one dime? What's the percentage? 7.5%. Does everybody itemize their deductions? Does everybody itemize their deductions? No, because if you don't itemize, you're going to take what? Standard deduction that's automatically given to you for just being alive. Okay? If you're single, you get an amount. If you're married, you get an amount. And if you itemize, typically I ask my clients, do you have high charitable contributions or do you own a home? And if they do, then I go the itemize window and I see if they have enough to be greater than their standard deduction, which for married individuals is about $12,000. And if they do, if they have more than $12,000, of course, we itemize that. And we really start digging in for employee expenses and those items. Okay. Anything else?
Can you define a passive investment? What is a passive investment?
A passive investment is if you are, if you're not actively involved in the affairs of the business. So you own a portion of a partnership. You're a limited partner. And you have nothing to do with making the decisions. You just gave $5,000 as ownership, and now you get a K-1 from the partnership, and it says you're a passive partner. So passive income, you can't take that as a loss. It's just deferred. Well, you can take it as a loss up to $25,000, but if it's more than $25,000, you can't take it. And if your income is more than $150,000, you can't take the loss. So he's asking if I own, and people do this, give them $25,000 investment or 5 or 10, and you're limited partner, you get a K1 and it has a $30,000 loss on it, that's your portion. You can't take over, it's limited at $25,000, and if you earn over $150,000, you can't take any of it. Called passive income. That answer?
Yeah.
Where does head of household fit into the status?
It's,
Single and
it is. It's between single and married filing joint. And if you're head of household, your standard deduction for head of household this year is $8,700. So can you see where that fits? See, the 6 was single and the 11.9's married filing joint, and you're kind of in between there. And that's where you weigh whether you're going to itemize or whether you're going to take the standard deduction. And for all these limits that I'm giving you, it's the married filing joint limit is where you would take for whether you can, different credits and things that start to phase out. Okay.
Is the state tax deduction, is that new this year?
No. It's state taxes paid, so I ought to be clear on that. You know the state tax that comes out of your check? And let's say you have $2,000 in state tax that comes out of your check, but when you do your state return, you only owe $1,000 and you get a $1,000 refund. The amount that you can deduct is just the $1,000 paid. So it's state taxes paid. But it's, they take it out of your check. If you pay all of it in, then you can take the full amount. Oh, I ought to cover this. People have claimed, like for years, in Utah we used to have, you know how when we register our cars, and every year we register our cars? Years ago, we used to pay tax on our vehicles based upon the value of the car. So that's called a tax. See, we don't pay that anymore. We pay an age-based fee. You can only deduct taxes paid. So your cars, the amount that you pay on your car registration is not a tax, it's a fee, non-deductible in the state of Utah. Now you move over the line and live in Mesquite, you can take it because they pay a tax. State of Utah decreased our registration, keep it more, so it's based upon the year. It's supposed to save us money, and it is. We pay less to register our cars in Utah than they do in Nevada and California. But consequently, because we pay less, we can't take it as a deduction because it's a fee versus a tax. You can only just keep it this way. You can only take a tax deduction based upon value of your property, real estate, that's a tax. It's on a car, you can take a tax deduction if it's based on the value of the car. And we pay it based upon the year. So that's when I see errors on all the time. When somebody does their own tax return, they take that.
Someone's working out of state and that state doesn't charge state income tax, but their residence is Utah. Will you explain that?
Yeah, that's a good one. Utah wants your money, and they are really going to they're really honing in on that in the last few years. I had a client that's an attorney in Vegas, and his wife lived up here in Utah, and he worked down in Vegas. But he had to prove that he was not a Utah resident. See, if you have a home in Vegas, so husband and wife, husband's in Las Vegas, wife's up here in Utah. If you have a home in Cedar City, Utah, and you have all your mail coming to Cedar City, Utah, the husband has all his mail, and he buys a hunting license, and he has a driver's license in Utah, and he insures all of his cars in Utah, he's a Utah resident. And Utah wants every dime of that tax that's earned in Nevada. Okay, because he is a Utah resident even though he works in Nevada. He chooses, this is how they look at it, he chooses to work in Nevada and live in Utah, so he's going to pay Utah tax, just like we pay federal tax when we choose to live in the United States. So what happens with that is with this client, now he was an attorney, so he knew how to fight with the Utah state government. But he was savvy, and he kept his driver's license. He insured all of his cars in Nevada. He bought an out-of-state hunting permit. He did everything, and he had a home that he maintained in Nevada. So he fought with him, and he actually won. On the other hand, I had a poor client who's not an attorney. He didn't win, and they came after him for about $18,000 in past Utah tax because he had tried to be a non-resident for years and years. And at that point, when he came to me to help him out, it's too late. 10 till. Oh, I got to go to class. No other questions? All right, happy taxes. Have a good time. See ya.